Your complete guide to insurance riders. When it comes to life insurance, most people think it's just a simple policy. You pay the premiums and your family gets a payout if something happens. But what if you could customize your life insurance to cover even more? What if your policy could adapt to your needs as your life changes? So that's exactly where insurance riders come in. And today, we're going to show you how to use them strategically to protect your family, your business, and your wealth in Canada. Hi, my name is Laurent and I'm a partner and advisor here at Safe Pacific Financial. If you're new to the channel, welcome. And if you've been with us before, welcome back. So at Safe Pacific, we specialize in helping Canadian business owners and their families to grow, protect, and transfer their wealth using advanced yet easy to understand financial strategies. If you want to work with us to create a custom life insurance plan that fits your goals, you can go to our website at safepacific.com and you can reach out through the contact form there. So let's get started. What are insurance riders? So you can think of insurance riders as a custom add-on to your life insurance policy. They let you personalize your coverage that gives you protection that's tailored to your unique financial situation. It could also expand your coverage beyond just a death benefit payout when it comes to life insurance. It can create more flexibility for emergencies, like if you had a disability or contracted a critical illness. And also it can help to support major life changes like a marriage or having kids or home ownership. Now you want to keep in mind, the riders will usually increase your premiums, but the added value and security they provide can be well worth it. And then that's where we work with you to figure out, is it worth it? So now why would you consider adding riders to your life insurance policy? Adding riders to your policy can help you do a few things. It can help extend the protection beyond the basic coverage. It can help to build financial flexibility. It can help you prepare for unexpected life events. And it can help protect your legacy and your family's financial security. But not all insurance companies in Canada offer every rider option. So working with an advisor ensures that you get exactly what you need because we know which companies have what. The best time to add the rider is at the beginning of the policy during the application process. Can you add the riders after buying the policy? Well, in most cases, no. Adding a rider after the policy is active is complicated and it doesn't always work and not all the companies offer it. However, removing a rider later is simple. You just notify the insurance company and they'll adjust your premiums, or you notify us, the advisor, and we notify the insurance company. So let's do a deep dive. Here are some common life insurance riders in Canada. Let's explore some of the most useful riders that Canadian families and business owners can add. So number one is a term rider. So a term rider is an optional add-on that provides additional term life insurance coverage that can be layered on top of a base permanent life insurance policy. You can choose options term 10, term 20, or even term 30, depending on your coverage needs, depending on how long you need it. Term riders are particularly popular in Canada because they offer a cost-effective way to increase your insurance protection during the years when you need it the most without committing to a massive permanent policy from day one. So why would you add a term rider to a life insurance policy, to a permanent policy? Well, you need the higher protection during your high need years. So life tends to be the most financially risky when you're younger. So you have a mortgage, maybe student loans, you're raising kids, you have a business loan. So adding a term rider ensures that you have enough coverage to protect your family and your financial obligations during this time period where, you have a lot of responsibilities. Another thing you can do is a laddering strategy to match your decreasing needs. So as you pay off your mortgage, as you grow your investments, as your children become financially independent, your need for a large amount of life insurance typically decreases. So laddering multiple term riders allows your coverage to automatically adjust downward over time, keeping your protection in line with the actual financial risk. So what that means is, so maybe you have a permanent policy and you add a term 10 for a larger amount and a term 20 for a smaller amount. So after the 10 years, you get rid of the term 10 and then you're left with your permanent policy and the remainder of the 20. And then after the 20 years, you get rid of that term policy and then you have the permanent amount. Also with those term riders at any time, you could convert all or part of those to a permanent policy. So it's a way to have a lot of insurance now for a lower cost, and then have that cost go away as those terms expire, or give you the option to convert those into permanent later when you probably have more money, you've got greater finances. So it's a cost-effective way to maximize protection. So permanent life insurance policies like a whole life can be expensive when starting out. So adding the term rider to your base policy gives you high coverage at a lower cost, ensuring you don't sacrifice protection while you build your career or your family or your business. So at Safe Pacific, we frequently use term riders when structuring life insurance policies for Canadian business owners or professionals. By combining a smaller base permanent policy with a larger term rider, this allows clients to maximize cash contributions into the policy. It allows you to boost cash value growth. It can create borrowing opportunities through policy loans, and it can keep your premium costs lower compared to buying a massive base permanent policy. This strategy is particularly useful when you're using your policy for the infinite banking concept or for an immediate financing arrangement, or if you've got a corporate-owned life insurance policy in Canada. Another rider you can add is called a critical illness rider. So a critical illness rider is an optional addition to a life insurance policy that pays out a tax-free lump sum if you're diagnosed with a covered serious illness. And this is usually cancer, heart attack, strokes, kidney failure, or other major life-threatening conditions. This payout is separate from the death benefit. It's designed to support you while you're alive during one of the most financially stressful periods of your life. Critical illness insurance is extremely valuable for Canadians given the high cost of healthcare-related expenses that are not always fully covered by provincial health plans. Now, why would you add a critical illness rider to your Canadian life insurance policy? To cover unexpected medical and recovery expenses. So even in Canada, certain specialized treatments or medications or traveling for care or home modifications or private nursing, these all can be very costly. So the lump sum payout from a critical illness rider can be used to cover these unexpected medical expenses without dipping into retirement savings or investments. It can also protect against lost income and additional costs. So a serious illness could mean months or years off of work. So your critical illness benefit can help to replace lost income. It can pay your mortgage. It can cover childcare. It can fund travel and accommodations if you need treatment in another city, or if you want people to come to you, like maybe your parents or your sister lives somewhere else and they want to come out for you and help you. It can also safeguard your retirement and long-term wealth. So without a critical illness benefit, you might be forced to drain your RRSPs or your TFSA or corporate investments to pay for care. But by adding the critical illness rider, you shield those long-term financial plans and you keep your retirement goals on track, even in the face of a major health crisis. Critical illness insurance and a critical illness rider also complements disability insurance for a complete protection. So disability insurance replaces a portion of your income if you can't work due to a disability or critical illness, or if you're sick or injured. The critical illness rider provides a lump sum payout that you can use for anything: medical bills, family needs, or personal care. Having both disability and critical illness creates a more comprehensive safety net for yourself and for your family. Now, here's a special option that fits in here. It's called Canada Life's Second Event Rider, or Second Chance Protection. So this is only Canada Life. They offer an innovative add-on called the Second Event Rider. So this rider provides a second critical illness payout if you suffer from a different major illness after recovering from the first. For example, so if you receive a critical illness benefit after surviving a heart attack before you're age 65, and then you're diagnosed with life-threatening cancer, in the next 10 years or something like that, you would qualify for a second full payout. So this added layer of protection is especially valuable for those with a family history of multiple illnesses, or anyone who wants maximum health protection built into their financial plan. Now, who should consider adding a critical illness rider? Well, for sure, business owners who rely heavily on their ability to work to generate income, professionals who want to protect their retirement savings, and then families who want financial stability in case of serious health events. Also, anyone with family history of a major illness like cancer, heart disease, strokes, and then Canadians that are looking for comprehensive risk management strategies. Now, here's another rider that you should definitely look at. It's called a guaranteed insurability rider. A guaranteed insurability rider is an optional feature that you can add to a permanent life insurance policy that allows you to purchase additional life insurance coverage in the future without undergoing new medical underwriting or health exams at that time. So this means no matter how your health changes over time, you will always have the option to increase your life insurance protection, guaranteed. It's one of the smartest add-ons for Canadians who want long-term flexibility in their financial planning. Now, why would you add a guaranteed insurability rider to your policy? Well, one reason is you're planning for major life changes with confidence, right? Life evolves, and so should your insurance coverage. A guaranteed insurability rider lets you buy more life insurance at key milestones. So maybe getting married or having or adopting children, or buying your first home, or expanding your business. Without the need for a new health evaluation, you can easily increase your protection as your responsibilities grow. It locks in your insurability now, so regardless of future health. One of the biggest risks young Canadians face is losing their ability to qualify for affordable life insurance later due to illness or injury or a medical condition. So with this rider, you secure your right to buy more insurance even if your health deteriorates without the higher risk ratings or actually just getting flat denied. This rider's perfect for young professionals, for entrepreneurs, and for new families. If you're a young professional just starting out, or a business owner that's scaling your company, or a new parent, the Guaranteed Insurability Rider is a cost-effective way to build financial flexibility into your plan. And it's a cost-effective way to expand coverage. Right? So adding a guaranteed insurability rider when you first set up your life insurance policy is much more affordable than trying to apply for a new standalone policy later in life if there's health risks or as your premium costs, they'll tend to rise. So how does the guaranteed insurability rider work? When you first buy your permanent life insurance policy, which would be whole life or universal, you can add the rider. So your insurance provider will offer specific windows or life events where you can exercise your right to purchase more coverage. You won't need to take another medical exam or answer any invasive health questions, and your additional coverage will be issued based on your original health rating from when you first applied. So each insurance company has its own rules about how often and how much you can increase your coverage. So again, it's critical to work with an experienced advisor to design the plan correctly from the start. Now, why are Canadians adding guaranteed insurability riders more than ever? Well, with health uncertainty rising and the cost of living skyrocketing, Canadians are increasingly aware that locking in life insurance options early can make a huge difference in their financial security later on. It can protect against unforeseen health changes, and it can expand your coverage without the costly medical underwriting, and it can keep your financial goals on track as your family or business grows. Now, here's another important rider to look at. It's called the Disability Waiver of Premium Rider. So a disability waiver of premium rider is an optional add-on to your life insurance policy that waives your future premium payments if you become totally disabled and unable to work. So in other words, if an accident or illness or injury prevents you from earning an income, your life insurance policy will remain active without you having to pay a single dollar. This rider acts like a built-in safety net, ensuring that you don't lose your valuable life insurance coverage at a time when you might need it the most. So why Canadians should consider adding a disability waiver of premium rider? Well, it keeps your life insurance coverage intact during a disability. So if you suffer a serious injury or you develop a medical condition that prevents you from working, the last thing you want to do is lose your life insurance due to missed premium payments. So with the disability waiver of premium rider, your life insurance policy stays in force, preserving the death benefit for your family and the cash value growth if you have a whole life policy. It'll also help to reduce financial stress when your income drops, right? Becoming disabled can create enormous financial pressure. You have lost income, rising medical bills, and lifestyle changes. So this rider removes one major expense, which would be your insurance premiums, from your list of worries so you can focus on the other things, on recovery and rehabilitation. And this is critical for Canadians in high-risk occupations and entrepreneurs. So if you work in, say, construction or transportation or law enforcement, healthcare, or if you own a physically demanding business, your chances of injury are statistically higher. Entrepreneurs and self-employed Canadians also benefit from this rider since they typically don't have employer-provided disability plans to fall back on. And then this can help to protect your estate and your legacy plans. So a disability doesn't just affect your income today, it can disrupt your entire financial plan for the future. So keeping your life insurance policy active through a period of disability ensures that your long-term wealth building and estate planning goals stay on track. So how does the disability waiver of premium rider work? Well, if you experience a qualifying disability, which would be defined in your insurance policy, you submit a claim to the insurance company. After an elimination period or a waiting period, which is usually 90 or 180 days, the insurance company will start waiving your life insurance premiums. Your base policy and any existing riders stay fully active as if you were still paying out of pocket. Some policies even refund premiums paid during the waiting period once your claim is approved. Different insurance companies have different definitions of disability, so it's critical to work with a knowledgeable advisor and choose the right policy that offers a clear, fair definition of disability. Why is adding a disability waiver of premium rider smart for Canadian life insurance policies? Well, it ensures uninterrupted coverage during, one of life's most stressful and vulnerable moments. It helps to preserve the cash value accumulation in permanent policies like whole life insurance or universal life insurance. And it shields your family's financial security, even if your health situation unexpectedly changes. And it offers peace of mind that your insurance strategy will survive financial hardship. Now, here's an insurance premium rider that we use a lot. It's called Return of Premium Rider, or ROP. So an ROP rider is a valuable add-on that you can include with a term life insurance policy in Canada or a critical illness insurance policy. It promises that if you outlive the term of the policy, the insurance company will refund 100% of the premiums to you, tax-free. And then with critical illness policies, it's usually after some sort of date, like after 10 years or 15 years. If you don't use the policy, you can cancel it and they'll give you all your money back. So unlike traditional term life insurance, whether you either win by dying early or lose by living, a return of premium rider ensures that you benefit either way. So if you pass away during the term, or for critical illness, if you get one of those critical illnesses during that term, you or your beneficiaries would receive the full benefit. If you survive the term, you get all the premium payments back. So think of it as having insurance with a built-in money-back guarantee if you don't use it. Now, why would Canadians add a return of premium rider? Well, it creates a forced savings plan while protecting your family. With a return of premium rider, your life insurance premiums double as a long-term savings strategy. If you don't use the coverage, you're not left feeling like you wasted your money. You're simply putting away savings over time. It provides financial peace of mind. So many Canadians hesitate to buy term life insurance because they worry that they're going to pay premiums for 20 years and get nothing if they stay healthy. And same with a critical illness policy. But this ROP rider eliminates that fear. So either, your family's protected or you get your money back. And so this makes term life insurance feel sort of like an investment. So while the life insurance shouldn't be viewed as an investment vehicle, adding a return of premium option transforms your policy into a smart financial move that serves you well. So whether you claim the death benefit or not, or on a critical illness insurance policy, whether you claim the benefit or not. So, and the refund is completely tax-free, right? The premium refund at the end is tax-free in Canada, giving you a lump sum of cash that you can use for other things like retirement or investments or any other goal. This rider is ideal for young professionals and families. So if you're starting out in your career, you're buying your first home, you're raising a young family, a return of premium rider provides protection now and a financial bonus later if you don't use the insurance. So how the return of premium rider works? Well, you purchase a term policy, a term insurance policy. For life insurance, it's usually 20 or 25 or 30 years. For critical illness insurance, it's usually a 20-year policy or sometimes till age 65. And you add the return of premium rider at the time when you set it up. You pay a slightly higher premium than basic insurance that doesn't have the feature. You're paying for the rider. And then if you outlive the policy term and you haven't made a claim, the insurance company refunds all the premiums that you paid tax-free. If you make a claim or if you pass away during the term, your beneficiaries would receive the full death benefit or you would receive the full critical illness benefit. So now, as a reminder, the return of premium riders need to be added at the time you set up the insurance policy. You usually cannot add it later. So again, it's important to work with an advisor to decide upfront if it fits your financial strategy. So is a return of premium rider worth it for Canadians? Well, that really depends, right? If you value the guaranteed protection that the life insurance offers or the critical insurance offers, but you also want the option to get your money back if you stay healthy, then it's a fantastic option. If you're financially disciplined and you're already saving aggressively somewhere else, you might prioritize having lower cost basic insurance without the rider, and then you're going to invest your money somewhere else so that it's there anyways in the next 10, 15, 20 years. But for many Canadians, the peace of mind knowing that their premiums are not wasted is priceless and can make buying life insurance feel like a win-win decision. Another rider we use a lot is the child rider. So a child rider is an add-on to your life insurance policy that provides low-cost term life insurance for all your children, both now and in the future. So this rider typically covers biological children, adopted children, stepchildren, and it automatically extends to future children without additional underwriting. So rather than purchasing separate policies for each child, a child rider bundles the coverage under your own life insurance policy, making it cost-effective, easy to manage, and highly flexible. So why do Canadian families add a child rider? Well, it covers funeral and counseling costs during unthinkable times. So like if you had the death of a child, this is emotionally devastating and financially stressful. So a child rider ensures that you have a tax-free lump sum available to cover things like a funeral, memorial expenses, counseling service for the remaining family is super important, time off work to grieve and heal. And one of the reasons people don't add this rider on is because they usually don't want to think about things like this. You know, it's a tough subject, and I recognize that, but at the same time, it's reality. And, you know, these riders exist for a reason because they do get claimed. Another thing too is it protects your child's future insurability. So one of the biggest advantages of the child rider is it can secure your child's right to future permanent insurance without medical underwriting at that time, even if their health has changed between now and then. So later in life, your child can convert the coverage into a permanent policy, even if they have health issues that would otherwise make insurance hard or impossible to get. It's also a cost-effective way to cover multiple children. So for just a few extra dollars on top of your policy, you can cover all of your eligible children under one rider. So it's making it one of the most affordable and high-value riders that you can add to a policy in Canada. It also gives automatic coverage for future children. So many Canadian insurance companies will automatically extend the child rider coverage to your future children without requiring a new application. So if you're planning to grow your family, this rider ensures newborns are covered from the early days without any extra hassle. And there's also flexible transition to adult coverage. So once the child reaches a certain age, and again, depends on the insurance company, but it's usually like 21 or 25 years old, they often have the option to convert their child rider into a fully fledged permanent life insurance policy without any medical exams. So this gives them a strong financial foundation early in adulthood. So how does a child rider work in Canada? So you add the child rider when you set up your own life insurance policy. It covers all current and future eligible children under one rider. And then you would receive a tax-free payout if one of the covered children passes away while the policy is active. Then at the end of the rider term, so the children can convert their coverage into a new permanent policy without medical underwriting. Now, it's important to note the coverage amount for the child riders is usually not super high. It's like between $10,000 to $30,000 per child. So it's intended to cover immediate needs rather than long-term financial planning. So it is really for emergencies. If you are looking to get more coverage than that, then we would recommend setting up independent coverage for your kids as they're born or as they reach whatever age you feel that they need that coverage. But the child rider is great, and it's usually pretty cheap to add onto an adult policy. Is a child rider worth it? So for most Canadian families, yes. It's one of the most affordable ways to add meaningful protection for your family and to secure your child's future financial options. So adding a child rider to your life insurance policy offers emotional and financial support during the worst case scenario. It offers guaranteed access to permanent life insurance later, and it offers financial flexibility for your children when they grow up. So for the minimal extra cost, the peace of mind it provides is invaluable. Now, another rider you can add is called a spousal rider. A spousal rider is a life insurance add-on that allows you to extend your coverage to your spouse under your existing policy. So rather than buying two separate life insurance policies, this is a cost-effective and convenient option for couples who want to ensure that both partners are protected under a single plan, while streamlining the management and the premium payments. I would say you do the spousal riders as a good option if you know you're going to stay together. Sometimes we also do recommend that the spouses should get their independent insurance, because then you have that modular flexibility to make changes to one or changes to the other. Or if, we know the statistics that divorce is an existing thing and it happens. So sometimes having separate coverage makes separations easier. But why would you add a spousal rider to your life insurance policy? Well, number one, it's really a cost-effective alternative to two policies. So instead of purchasing an entirely separate life insurance policy for the spouse, you can simply add a spousal rider to your own policy. So this allows you to protect your family for a lower overall cost. And this is especially important in the early years when your budget may be tight. It's also simplified policy management, right? So managing one policy instead of two makes things easier for premium payments or policy renewals or beneficiary updates or changes to coverage, even just changing your bank account. Everything's consolidated under one insurance contract, which makes the administration smoother if you're a busy Canadian family. And it's financial protection for both partners. So life insurance isn't just about the primary breadwinner. So a spousal rider ensures that whether your spouse is working full-time, part-time, or managing the household, their economic value is protected, which helps to cover things like childcare or household costs, mortgage payments, lifestyle. And it has easy conversion options, right? So some Canadian insurance companies allow spouses covered under a rider to convert their coverage to a standalone permanent policy later without needing medical underwriting. Especially, this is especially valuable if their health changes over time. So some important considerations to, when you're adding the spousal rider is there's coverage limits. So the spousal rider coverage amounts are typically lower than what you would get if you got a standalone individual policy. If your spouse requires a larger death benefit, a separate policy may still be the better option. And then there's underwriting requirements. So your spouse will usually need to go through a medical underwriting or to answer health questions at the time that we add the rider. And then, like I said before, right, the policyholder relationship. So some policies allow common law partners to be added with proper proof of the relationship, and you don't have to be just legally married. But then again, if there's a separation and you're tied to this policy, then it becomes a little bit more difficult to separate them. There's also, these spousal riders give you long-term flexibility. So if your family's financial situation becomes more complex later, then, you might be able to separate the policies and customize coverage for each partner. So is a spousal rider right for you? The spousal rider is ideal if you want affordable, basic life insurance protection for your spouse, if you're looking to simplify your family's insurance plan, and if your spouse's insurance needs are relatively modest for now. Also, if you value having the flexible conversion options in the future. However, if your spouse has significant income replacement needs or a complex estate planning goal, it's probably smarter to consider a standalone policy to maximize the coverage. And again, I've just said that sometimes it can be difficult to separate the policies and sometimes it's easy to separate the policies. This comes down to the insurance companies. Some are easier than others. This is why you would work with somebody who knows what they're doing, like us, who knows the different options that are available at the different companies that are going to suit your needs. Now, this is another big rider that we use a lot, especially with whole life insurance. It's called a paid up additions rider, or PUA. So the paid up additions rider is one of the most powerful tools available inside a Canadian whole life insurance policy. So it allows you to use the dividends that are earned from the policy to automatically purchase additional permanent paid up life insurance without requiring any additional underwriting or a new application. So each paid up addition that you buy increases both the death benefit, which creates a larger legacy for the beneficiaries. It also increases the cash value, which boosts the tax advantage wealth accumulation. And because it's permanent insurance, it never expires and requires no future premium payments once it's purchased, right? It's paid up additions. So why add a paid up addition rider to your whole life policy? So number one, if you are joining us because you've seen some of our infinite banking videos, the paid up additions rider is an integral part of how that concept works. And if you're doing infinite banking, then you have to have it. And it's totally a part of the way it works because it accelerates the cash value growth, right? The paid up addition rider helps the policy's cash value grow much faster than it would with just the base premium alone. So each paid up addition earns its own dividends, which creates a powerful compounding effect inside the policy over time. Like I said, it's essential for infinite banking or cash flow banking or IFA strategies or all of the other names that these things are called. And if you're serious about setting up infinite banking or cash flow banking or family banking or whatever, or an immediate financing arrangement, then it's mandatory. The paid up additions rider also builds the liquidity inside your policy that you can later borrow against. So whether it's investing or business opportunities or for a major purchase, without interrupting your growth. And you also get this automatic lifetime growth, right? By reinvesting the dividends through the paid up additions, your insurance coverage increases automatically year after year without needing additional underwriting or manual contributions. It can also boost your death benefit without new medical exams. So as your policy grows, so does your death benefit, without having to go through medical underwriting again. This provides a major advantage if your health changes later in life. It can also increase your wealth transfer to your beneficiaries. So because every paid up addition permanently boosts your death benefit, you're eventually going to pass on more money and you're amplifying the tax-free payout that will eventually go to your beneficiaries. So how the paid up addition rider works in Canada? Well, you purchase a participating whole life insurance policy, and the policy earns annual dividends based on the performance of the participating fund, which is managed by the insurance company. Now, instead of taking dividends as cash, the dividends are automatically reinvested into purchasing kind of like mini, fully paid up permanent insurance policies, right? So each year you get a little bit. Each new addition grows the total death benefit and the cash value without requiring medical evidence. So in Canada, the providers like Manulife, Sun Life, Canada Life, Equitable Life, who we work with all the time, they all offer paid up addition options on their PAR policies, on their whole life participating policies. So now who should consider adding a paid up additions rider? This is ideal if you want to maximize the cash value growth early in your policy. This is also super important if you plan on using the infinite banking concept or family banking or whatever name you want to use, or other leverage strategies like an IFA, an immediate financing arrangement. It's also super important if you want a larger tax-free death benefit for your estate. And if you prefer a hands-off strategy where your insurance policy just grows on autopilot, you don't have to do anything. And if you want to accelerate the liquidity for future opportunities, like if you're going to borrow against your policy for real estate investments or business expansion, or for funding retirement or buying other types of investments. So you're going to use the paid up additions to build up a private wealth system. So at Safe Pacific, we help clients use paid up additions riders to design then their customized private banking systems, which allows them to have policy loans at low rate or to have collateral loans with banks at low rate. And it allows them to continue compounding the growth uninterrupted and creates a stable tax-free wealth that'll last generations. And we integrate these paid-up addition rider strategies into comprehensive plans for business owners, real estate investors, retirees, and high-net-worth families across Canada. Now, why do all of these life insurance riders matter? Customizing your life insurance with riders allows you to future-proof your financial plan. It protects your family more completely and can create opportunities for wealth building and tax-free growth. So it can get you more protection, it can get you more flexibility, it can get you more control over your financial future. But remember, not every rider is right for everyone, and not every insurance company offers all of the same rider options. So again, that's why working with a professional advisor is critical when you're building a custom life insurance strategy for yourself. At Safe Pacific, we specialize in helping Canadian business owners, families, and retirees to build customized, tax-efficient life insurance plans that support their real goals, whether that's financial independence, business succession, generational wealth transfer. Now, if you're ready to design a policy that's tailored for your life and not just off the shelf, or you clicked a few buttons on a website and a robot sold it to you, visit safepacific.com. You can send us a message there through the contact form. Those will all come to me and to our team, and somebody will reply to you within 24 hours, and we'll set up a meeting time to really get to understand what you're trying to do. Before you go, if you found this video useful, please hit the like button, add a subscribe on the button. If you have any questions, leave a comment below. Why am I asking you this? Well, because it's tough to get a lot of virality on a life insurance video, because this isn't generally what the kids are looking for. So by clicking like, by clicking subscribe, by leaving comments, this shows the algorithm that you're interested in it, and it'll help to show these videos to more people that are successful and that want to take care of their business and their family. that are just like you. Now that's it for me today. Thanks for watching, and I will see you next time.